Welcome to the deep dive. Okay, so today we're diving into something that feels a bit like whiplash in the economy.
Yeah, it's like you're getting two completely different stories at the same time.
Exactly. On one side, you see these positive signs. Strong U.S. dollar, interest rates are up, so savers get a bit more return, unemployment's low, GDP is growing.
Mm-hmm.
And you hear people echoing what, say, former President Trump often said about having the best economy ever. That narrative is definitely out there.
But, and this is the big what we're digging into,
Uh-huh.
there's this completely opposite view, a view that sees the markets maybe teetering on the precipice of collapse, as some put it.
Right. Those shadows of negativity, as the source calls them.
Yeah, things like the U.S.-China trade situation, the trade war, how that's hitting manufacturing, hitting emerging markets.
And the stock market itself, signs of overvaluation maybe. Companies
Right.
with these huge valuations.
Huge.
Yeah.
But without what a traditional value investor might say, justifies that number,
Plus, the central bank keeps hiking interest rates. 3 times last year alone.
which in a society that runs on debt like ours, well, that puts a real strain on things.
So that's the tension. And we're exploring it through an article by Tyreek A Gaynor-Fray titled The Coming Crisis. History does not repeat, but it does rhyme.
And the author is pretty direct. He believes, given where things stand globally, we're heading for a major correction. Not just stocks, but the whole central banking and fiat money system.
He uses this analogy. It's quite vivid, like there's enough snow piled up for an avalanche.
Right. But the trigger isn't usually some huge event. It's that tiny piece of snow that finally sets it off.
So our mission today, unpack that argument, look at the history he brings up, understand why he sees a crisis coming.
Let's do it.
Okay, so let's start at the foundation, like the author does, fiat currency. What exactly is he talking about here? For, those of us not steeped in economic theory daily.
Right. So fiat currency is basically the paper money in your wallet, the dollars, the euros, whatever. Its value, he argues, isn't backed by anything physical like gold.
Nothing physical.
No, it's backed purely by the confidence we all have in the central bank that issues it. It's a trust-based system, really.
And that's newish, right, in the grand scheme of things.
Surprisingly new. The author points out this current system, globally, has only really existed since 1971.
1971, wow, what happened then?
That's when President Nixon took the U.S. dollar off the gold standard. He basically said the U.S. would no longer exchange dollars for gold at a fixed rate.
Okay.
Before that, like if you look at an old U.S. bill, say a 1926 $20 bill, it literally said on it that there were $20 in gold coin deposited in the Treasury, payable on demand.
Huh. So it represented actual gold somewhere.
Exactly. Compare that to a modern bill, a Federal Reserve note. It just says it's money, value from the Fed. It's a fundamental shift.
So taking away the gold backing, that gave governments a new power, didn't it? The power to create money.
Pretty much out of thin air, yeah. And the author argues that power is central to the problem. It allows governments to spend way beyond their means,
Leading to crashes.
while leading to excessive spending, which then contributes to market bubbles and crashes, and what happens after a crash. Often, more money printing to try and fix it.
Which brings us to quantitative easing, QE. We heard that term a lot after 2008.
A lot. The author notes there were 4 rounds of QE just after the 2008 crisis, basically pumping massive amounts of new money into the system.
And the consequence of all this printing and spending, according to the author.
Massive debt. He points to the U.S. national debt sitting at, what, almost $20 trillion? This constant creation of money with no anchor, he argues, it's inherently unstable.
Okay, so that massive debt pile, how does that connect to the interest rate hikes we mentioned earlier?
It connects directly. Think about all those companies, especially the high-growth ones we hear about. Many of them grew by borrowing tons of money when rates were super low.
Cheap money fueling growth.
Exactly. Yeah. But now rates are climbing. Servicing that old debt gets much more expensive. And borrowing new money for future growth, also more expensive.
So the author thinks the market can't handle these higher rates for long.
Pretty much. He says there's no possible way that the markets can sustain itself for so long under these conditions. We're already seeing, earnings reports maybe not looking so great, stocks selling off.
This also ties into trade, doesn't it? Specifically, President Trump's America First approach.
Yes, the author brings this up quite pointedly. He argues that for years, while the Fed was creating all this currency, a lot of it didn't actually stay in the U.S.
Where'd it go?
It was essentially shipped overseas to pay for goods. We were importing things, paying with dollars. He calls it exporting inflation.
So we printed money, sent it abroad for TVs and clothes and stuff, and ended up with a trade deficit.
That's the argument. We paid with dollars, but didn't necessarily create equivalent value in goods to export back. And China's the prime example he uses.
Because they manufacture so much.
Right. They became the world's factory, effectively, and ended up holding a massive amount of U.S. debt, U.S. treasuries, as payment.
Okay, so how does America First change that dynamic in the author's view?
Well, the policy aims to reduce those trade deficits, bring manufacturing back, cut those ties to some extent.
Right.
The author predicts this means those dollars held overseas, those treasury notes, will start flowing back to the United States.
Increasing the supply of dollars here at home?
Potentially, yes. And this is happening at a time when that global cooperation we saw in 2008, well, it seems to be fading.
Less teamwork among central banks.
More of a climate of selfishness, as the author puts it. Countries are looking out for, number one, less willing to cooperate easily with the U.S.
Any examples of that?
He gives a couple. Russia significantly reducing its holdings of U.S. treasuries.
Yeah.
And China. Instead of just holding treasuries, they're using them almost like collateral, lending them out to gain stakes in infrastructure projects in smaller countries. Real, tangible assets.
That's a shift, so they're trading paper for ports and roads.
Seems like it. A strategic move away from just holding U.S. debt.
Okay, this is where the author brings in history. That phrase, history doesn't repeat, but it does rhyme. He sees parallels, right?
Big time. He argues that many empires, historically, started their decline with monetary problems. A failure in the monetarily, as he puts it.
And the big example is?
Rome, the Roman Empire.
Okay, what happened there?
Roman emperors figured out they could control the money supply. Their coins were originally silver or gold, but when they needed more money, maybe to pay soldiers or fund projects.
They couldn't just mine more gold overnight.
Exactly. So they started debasing the coins. They mix in cheaper metals, copper, iron, nickel, while still calling it, say, a denarius.
Sinky. So less actual silver or gold in each coin?
Progressively less. It was currency debasement.
Yeah.
And this was like
yes. Inflation.
hyperinflation eventually. Prices shot up, people's savings became worthless, trust in the money collapsed, you couldn't afford things, it destabilized the whole economy.
Wow. So the author sees echoes of that today.
He draws a direct line. After World War II, the Bretton Woods system made the U.S. dollar the world reserve currency because the U.S. held the most gold.
Right, we mentioned that.
But then came the Vietnam War, expansion of social programs. The U.S. government needed more money than it had gold to back.
So they started printing more dollars anyway.
Yes, and shipping them overseas for goods, much like he described earlier. This eventually led to Nixon closing the gold window in '71.
And this connects to how banks work today, fractional reserve banking.
Yeah, he touches on that too. It's the system where banks don't actually hold all the money deposited with them. They keep a fraction in reserve and lend out the rest.
Creating new money through loans.
Effectively, yes. It allows the money supply to expand. But the author points out the risk. If everyone suddenly wants their money back at once,
The bank run.
the bank doesn't have it all. When these contracts are all needed to be accounted for, many people lose their money. That's the inherent fragility she sees.
So, putting this all together, the move off gold, the money printing, the debt, what has that done to the value of the dollar itself over time?
According to the author, it's been decimated. He cites that since 1971, the value of the dollar has fallen over 90%.
90%. Since 1971.
That's the figure he uses. And another chart he references apparently shows a 96% drop since 1900.
So a dollar today buys only a tiny fraction of what it used to.
That's the implication for purchasing power. He also critiques the official inflation target, usually around 2% per year. He quotes gold money, describing it as like being in a sinking boat but telling society that we are trying to sink slower.
Just managing the decline, not stopping it.
That seems to be his interpretation.
Now, he also makes a pretty bold claim that real inflation is already much higher than reported and it's being suppressed.
Yeah, he talks about asset inflation.
Yeah.
The idea that when all this new money gets created, it doesn't just spread evenly. It flows into assets first.
Like what kind of assets?
Stocks, real estate, cryptocurrencies. He points to Apple and Amazon hitting trillion-dollar market caps, crypto prices going wild, housing costs soaring. That's where the excess money shows up first, creating overvalued prices, in his view.
So the inflation is happening, just maybe not showing up fully in the standard measure, the CPI.
Exactly. He's critical of the Consumer Price Index, the main way we measure inflation.
Why? What's the problem with CPI, according to him?
He says the basket of goods used to calculate CPI is constantly changed. It's algorithmically modified.
How so?
He uses the classic chicken and steak example. If steak gets really expensive, the CPI calculation might assume people will just switch to buying cheaper chicken instead.
So it substitutes items.
Right. But the problem, he argues, is that this masks the real loss of purchasing power. Maybe you still want or need the steak. It does not accurately measure the asymmetrical inflation or show clearly that your dollar just doesn't go as far.
Why would the CPI be designed that way, then? To make inflation look lower?
The author suggests it serves a purpose for policymakers. CPI is used to adjust things like Social Security payments, wages, retirement funds,
Ah, so if CPI is lower, those adjustments are smaller.
which saves the government money. He cites an estimate that between 1996 and 2006, these changes to CPI saved the government over $680 billion.
Wow. Okay.
So his point is, those interest rate hikes we're seeing now, they're happening because the real inflation is much higher than the official CPI number suggests. You feel it in grocery prices, gas prices.
College textbooks, he mentions those too.
Yeah, notoriously expensive. It's the lived reality versus the official statistic.
So given this pretty bleak picture, does the author offer any way out? Any solutions?
He does propose something called the guided market.
The guided market. Okay, what's the core idea there?
The goal, as he states it, is to restore the connection to natural productivity and performance, to create a more unified, orderly economy
How would it do that?
by connecting productivity and performance. He believes its adoption could actually avoid a coming crisis. It's about fundamentally changing what backs the currency
Okay.
instead of gold or just confidence. The idea is to peg the value price of the currency to the performance of the underlying population or country.
Peg currency value to national performance. How would that even work?
Well, the details aren't fully fleshed out in the summary, but the concept is that the currency itself would act as both money and an asset, reflecting the country's real economic health and output.
So if the country is productive, innovative, doing well, the currency value goes up. And if it's stagnant or declining,
The currency value would reflect that too. It aims to create a direct link between the money and actual value creation, moving away from just printing more.
interesting. So it would incentivize actual growth, not just financial engineering.
That seems to be the goal, to tie the monetary system back to tangible performance, making the currency itself reflect the nation's productivity. A pretty radical shift from the current fiat system.
All right, so let's recap this deep dive. We've explored Tyreek A Gaynor-Fray's arguments about a potential coming crisis. Started with that tension. Surface optimism versus these underlying issues.
Right. Fiat currency, massive debt from decades of maybe easy money and spending, shifting global trade dynamics.
And those historical echoes. Rome, currency debasement, the idea that history rhymes.
Yeah, and it really underscores the need to look closely at how we measure things like inflation and to not ignore historical patterns. They can definitely offer clues about today's challenges.
Understanding the why behind it all seems crucial.
Absolutely.
So here's a final thought to leave you with, based on the author's analogy. He talks about an avalanche waiting to happen, triggered by just a tiny piece of snow. Given everything we've discussed, the history, the critiques of fiat money, the current global interconnectedness, what might that unique tiny piece of snow be today? What specific trigger could set off the kind of crisis the author envisions, and how might it look different from collapses in the past? Something to think about.